What's up guys, Keith here. All my savings are in stocks. I don't own any bonds, I don't own any real estate, I don't own any Bitcoin or anything like that. And I don't buy individual stocks either. It's all in index funds. One of the reasons I named my channel Simple Bogle is a shout out to late Jack Bogle, who's the pioneer of index investing. He made index funds available to everybody through Vanguard. There's plenty of research and studies showing that index funds are a better way to invest for the regular guy compared to picking individual stocks. Most of the time, index funds are even better than professionally managed mutual funds. So even people who do this for a living get it wrong most of the time. Dustin from Logical Finance made a pretty cool video called Index Funds versus Stocks. If you haven't watched it already, it's a funny skit that makes a compelling argument for index investing. To summarize, even among professional mutual fund managers who do this for a living, only 15% of them beat the S&P 500 over a 15-year period. Only 8% beat the index over a 15-year period. A study done on retail investors show that over the last 30 years, individual stock pickers only yielded 4% compared to 10% yielded by the S&P 500. So if you have a full-time job and somewhat of a life, you're better off just investing in index funds rather than trying to pick stock. Warren Buffett has yielded 20% over the last 30 years compared to the S&P 500's 10%. But that's why he's famous. Survivorship bias is a real thing. The odds are you're not the next Warren Buffett. Sorry. The people mostly making money picking stocks are the people who are talking about picking stocks and recommending it to you. And there's no shortage of those here on YouTube or on TV. In this series, I want to revisit some of the stock picks by these smart stock pickers who are kind enough to recommend it to you because they're smarter and kinder than you, I suppose. Let's start with one by the granddaddy of them all, Jim Cramer.
This increasingly volatile market has you on edge. Maybe it's time to double down on a stock that gives you the security of a sky-high dividend yield. I'm talking about Cramer fave Linn Energy, L-I-N-E for you home gamers, the master limited partnership that also happens to be the 12th largest independent oil, gas exploration and production company in the country. Linn stock sports a notoriously big 7.7% yield. Now, at the same time Linn reported last week, the company also announced that it's buying Berry Petroleum for $4.3 billion. I gotta tell you, this is a brilliant deal. Berry brings some high-quality assets in California and Texas. More important, in the first year after the deal closes, it's expected to add more than 40 cents to Linn's distributable cash flow power per unit. Remember, we want yield to go higher, right? And we want it to come from a higher distribution. That's what should happen from Berry. I think this merger is huge for Linn's future.
That clip was from 2013 on Mad Money. Let's say you invested $1,000 or $3,000 or $10,000 in Linn Energy back in 2013. Let's see how it turned out. The same money if you put in the S&P 500, this is how that turned out. And here's Jim Cramer's Linn pick versus the S&P 500. This one's personal for me. Linn Energy was a big deal when I was graduating college. If you worked for them, they had high salaries, great benefits, and everything like that. So it's somebody I aspired to work for. But I didn't know their underlying financials or their debt load or how they hedged or anything like that. I didn't know how shale companies were exposed to geopolitics or geoeconomics or anything like that either. This was my first long stock holding. I had about $10,000 invested in Linn Energy. They were paying about 10% dividend at one point, which was great, till OPEC and Saudi Arabia decides to initiate a price war against US shale in 2015. After that, oil prices collapsed and Linn Energy went bankrupt in 2016. I'm sure Jim Cramer's fine with the CNBC income, but if you're an average investor, if you put like $10,000 into Linn Energy, you lost a good chunk of change. Whenever you buy an individual stock, you're taking on three kinds of risk. There's the risk associated with the company itself. The second one is the risk of the industry that the company's in. And the third one is the broader US economy's risk. These are not necessarily linear either. It's more exponential. I'm making these numbers up a little bit, but to make a point. Now, let's say you have a factor of 3 for company risk, industry risk, and the economy risk. If it was linear, your total risk would be a factor of 9, But when it's exponential, your risk is actually a factor of 729. The index fund has a risk factor of 3, and the individual stock has a risk factor of 729. Do you really want to take on 240 times more risk to maybe beat the market? Why? Because somebody said with confidence that the stock is going to do well because of a bunch of fancy sounding reasons? In the case of Linn, their company risk was their aggressive acquisition of shale assets. They had about $17 billion in debt because they were buying up shale companies. The industry risk was the price war started by OPEC. Whenever the commodity prices of their product went too low, they were in a spot where they couldn't make payments on their debt, and before you know it, they're bankrupt. The bankruptcy happened in 2016, where the broader US economy wasn't doing that bad. Whenever you're buying the index, all you're taking on is the broader US economy's risk. So this pandemic situation, that's going to affect the index fund. But that's going to affect individual stocks too. Oil and gas industry and airline industries were hit the hardest. And that's an example of industry risk. If you own individual stocks in those sectors, you're in a bad spot. And if there are companies that are not affected by the downturn, like the tech stocks in 2020, the odds are the index funds has those stocks in there. All the high flyers this year, like Amazon, Netflix, and Google, they're all part of the S&P 500 index. And if you're an index investor, the winning stocks in the index more than made up for the losing stocks in the index. And that's what happens in the long term when you own an index fund. And you don't have managers or fees or anything like that eating into your returns either. Thank you for watching, guys. I hope to do more of these stock picker versus index investor videos in the future. Until next time, peace.